Welcome to Talk Tickers. This morning, Viking Holdings dropped its Q3 earnings. And wow, the market has already delivered its verdict. We've gone through the report, we've listened to the call, and we're here to break down everything you need to know. Let's dive in. And that verdict from the market? It came in fast and it was loud and clear. Investors absolutely loved what they heard. The stock surged over 5% on almost double its average daily volume. So the big question is, what exactly fueled this rally? Well, the story here really starts with an incredibly solid set of operational numbers. This wasn't just some sentiment-driven pop. Viking delivered the hard data to back it all up, proving that their premium travel model is firing on all cylinders. Now, if you just glanced at the headlines, the beats looked pretty modest. Adjusted earnings per share came in at $1.20, which was just a penny ahead of what Wall Street was expecting. And revenue at nearly $2 billion was basically right in line. But trust me, the real story was hiding just underneath these numbers. And that real story begins right here with something called net yield. You can think of this as how much profit Viking squeezes out of each passenger every single day. Well, it hit a company record of $617, up over 7% from last year. This is a huge, flashing signal of some serious pricing power and incredibly high demand. And that pricing power, it flowed directly down to the bottom line. Adjusted net income shot up an impressive 34% year over year. This is just a perfect textbook example of operating leverage. See, revenue grew 19%, which is great, but profits grew way, way faster. That is exactly what investors love to see. The other huge piece of this puzzle is the balance sheet. We're looking at net leverage here, which is basically a measure of their debt compared to their earnings, and it fell a lot. It went from 2.1x all the way down to just 1.6x this quarter. This whole de-risking of the company's finances was a major theme on the call. So you've got these great numbers, and management's message on the call totally matched that strength. Their commentary wasn't just about taking a victory lap for one good quarter. It was all about framing a narrative of durable long-term growth and growing financial muscle. The CEO himself, Torstein Hagen, really set the tone. He framed their success around hitting a critical scale and achieving brand dominance, pointing to their fleet, which is now over 100 ships, as proof of their disciplined execution over many, many years. And look, it wasn't just talk. They backed it all up with serious action. Management made sure to highlight a recent credit rating upgrade from Moody's to Bad2, a successful $1.7 billion debt refinancing that pushes their payments way out. And they upsized their revolving credit facility to a full $1 billion. These are all very tangible moves that give them a ton of financial flexibility. And what was really interesting is that management also started talking up their tech game. They made it a point to discuss how they're using AI and data analytics in their marketing and revenue management to really dial in and optimize pricing. It feels like a clear effort to position Viking as way more sophisticated than its old-school peers. But honestly, the most powerful part of the entire bull case for Viking, and the thing that really drove the stock move today, is the absolutely incredible visibility they have into future revenue. Their advanced booking model is just in a league of its own. I mean, just look at this. As of the beginning of November, the entire 2025 season is already 96% sold out. That's just wild. The year hasn't even really started yet, and they have almost nothing left to sell. This gives them a rock-solid foundation for next year's results. And if you thought that was impressive, get this. They are already 70% booked for the 2026 season. Think about that for a second. That is just remarkable visibility. It gives management and investors a crystal clear line of sight into growth well over a year into the future. And here's the kicker. This massive volume isn't coming because they're slashing prices. Not at all. They've already locked in a 7.5% price increase for that 2025 season and a 5.5% increase for 2026. This means future revenue and profit growth isn't just a hope, it's already baked in. Okay, so let's put this all together. We have an excellent quarter, a de-risked balance sheet, and forward visibility that is just off the charts. But the stock has already had a monster run, and that, right there, sets up the classic investor dilemma. This is really the million-dollar question now, isn't it? The fundamental story is clearly fantastic, but how much of that good news is already reflected in the stock price? I mean, over the last year, Viking has more than doubled the performance of the S&P 500. And you can see this exact debate playing out on Wall Street. The analysts are pretty constructive, but you can see that tension. You've got Goldman Sachs, for example, raising their price target, seeing more upside. But then you have firms like Wells Fargo and Mizuho who are kind of saying, yeah, great results, but the valuation already reflects a lot of the good news. And that brings us to our rating here at Talk Tickers. We're initiating with a market perform. Look, let's be clear. Viking is a best-in-class operator and a fantastic company. No question. But at this price, it just feels fair. The strong fundamentals should provide a nice floor for the stock, but we think the valuation is going to cap any significant near-term outperformance from here. So what's the trade? Given our view, an interesting idea could be to sell cash-secured puts. So here's how that works. You agree to buy the stock at a lower price than it is today, and you get paid a premium, cash in your pocket right now, for making that promise. If the stock stays flat or goes up, you just keep that premium as income. Nice. If the stock does fall and you have to buy the shares, well, you just bought a great company at that lower price you wanted anyway. It's a potential win-win strategy for a stock you like, but maybe not at its current price. And as always, a final reminder, this is not financial advice.